Good morning, everyone. Thanks for coming along. Just to introduce myself quickly, James Tickner. I've run the investor targeting business at what is currently NASDAQ OMX, but previously the investor relations business within Thomson Reuters for the last 5 years. I've got a few things to cover with you today. I'm going to talk a bit about some of the buy-side trends that we're seeing from our perspective in the market, and how, of course, they're then flowing through to the need for companies to take more of a strategic approach to their investor targeting activities. We're then going to talk about a few sort of practical tips on how to balance a targeting plan, getting a good blend of obviously of the household names, but also some of the tier 2 institutions. And then, lastly, we're going to talk about how do we, prioritize individual funds, some unique methods to, looking beyond perhaps some of the most obvious pools of capital, and then finally through to how do we then measure the impact or the ROI of targeting activities, which I know is a question we get a lot from our clients. Okay, so to start off with some of the trends. Clearly, I think it's been very well publicized, the very rapid growth in ETF and passively managed investment vehicles over the last few years. Ernst & Young estimate that it's been $1 trillion that have flowed into ETFs between 2011 and 2013. Clearly that's putting a huge amount of pressure on the active buy-side model. Fees have come under pressure, as we know, and certain institutions have adopted a partial passive approach. Others, and I think more interestingly from an investor relations standpoint, have become more active in terms of stock picking, holding a more compact portfolio and holding stocks for slightly longer, which I think is great news from an investor relations standpoint. Clearly, the market has moved from being very macro driven to one where a company that can position its own story in the context of its own performance and attract new investment that way. Of course, part of the issue here for IR is, as company meetings become such a differentiating part of that investment process, the demands naturally on investor relations team for access have increased and are only going to continue to. Of course, as you get more demand from the buy side for access to divisional managers, to other board members outside the CEO and CFO, of course, IR team sizes and budgets are rising consistently with that. Well, unfortunately, that's not the case. Data from Extel clearly shows that budgets and team sizes are broadly flat across Europe. So there really does point to this need for efficiency around who companies are spending time with in terms of investor relations activities. Interesting statistic for you here. We ran some analysis on a sample of companies' meeting activity, so looking at the meetings they've done across the buy-side community, and we found that hedge funds were present in around a third of all of these meetings, whilst accounting for, when you look at their asset base, you take the US view, they're really only accounting for around 5% of the long equity ownership in the S&P 500, and according to data from the NASDAQ OMX DAX study client base, only around 1% of the DAX. So there's a real disconnect there in terms of face time with companies and executive management and actually assets managed. Now that's interesting because we know there's a few other reasons. We know that hedge funds typically can be quite secretive around their holdings. We know that they often use alternative instruments to gain exposure to companies without necessarily being long holders. But even if you were to bump that number up by 2 or 3 times, it's still a huge disconnect. Okay, looking back to some trends in our German client base at NASDAQ OMX, clearly the topic of today's presentation is very relevant given the considerable exposure of international investors to to German companies within the DAX 30. Almost 85% owned by international investors. When we look at some of the regional trends, I think there's quite some interesting themes emerging. Domestic ownership has come down slightly. This is over a 2-year view, so looking 2014 back 2 years. We see it's been broadly stable last year to this year, but it's been a 2 percentage point drop prior to that. At the same time, US ownership has been on a gradual decline, but still accounts for 30%, which is obviously extremely significant. What's interesting here, and I mentioned here that Norges Bank is now the largest international holder of German equities. You can see obviously that Norway, this is where that increase is coming from, but more broadly, the rest of world data really is accounted for by a lot of those sovereign wealth funds. So it's not only Norges. If you look at some of the largest international holders, you see SAFER in there, Qatar Investment Authority, Saudi Arabian Monetary Agency, all among those top investors. We do also probably expect that trend to continue. News from the South Korean sovereign wealth fund, the National Pension Board, this week around it, investing a huge amount. I think it's around a couple of $1 trillion in international bonds and equities over the course of 2015. Okay, so when we think about building a targeting plan, I wanted to look at the structure of the institutional market and think about how a well-balanced plan takes into account not only some of the largest institutions globally that everyone knows about, but also some of the second-tier funds as well. If we look here at the concentration of assets, so looking at assets under management along here and the rank among the top 1,000 active institutions, so not counting the State Street Global Advisors and those types of index funds. This chart is intentionally cut off, just given the size of the spike right at the top, with the Capital and BlackRock and institutions like that. But what I think this shows is that it's really interesting. If you look at the top 100 funds here, that is like over half the managed assets within this group. So that top 100 institutions, those are the names that everyone is chasing. Clearly within that group, there are better targets, and there are some that maybe the time isn't right for them to invest. But it's less a case of should you see or should you interact with those institutions. It's more a case of which ones are the most appropriate at a different time. What's interesting is when you move down to the next part of the market, so between investors 100 to 500, that's essentially unlocking a further 30% of those active assets. Interestingly, often within this group, you also get some of the longest holding periods. So I think this is an interesting area for companies to consider when they're thinking about balancing, the best opportunities, the names that everyone is going to be chasing within the top 100, out with some of the smaller names that make sense from a compatibility standpoint. Okay, so we can I think this hopefully captures that point a bit. We're looking at obviously the distribution of just those active assets by some of the key money centers across North America. It's no surprise, given the size of the blue bubbles on the East Coast and the West Coast, that is generally where many companies, the first port of call. Obviously, New York is by far the deepest market, both in terms of assets and in terms of the number of institutions. By definition, of course, it is also therefore where the most mistakes can be made. I think for most companies that are engaged in targeting international investors, engaged in roadshowing to the US, filling an itinerary is not an issue. It's really about prioritizing in those markets. Whereas it comes to to locations such as Denver, the question is really for many companies, should we even bother at all? Is that somewhere that we should visit IR only? Should we try and capture those institutions in a conference program? Or even in certain circumstances, should we, send our management team there because Janus are a great target? What's interesting as well, and this really highlights the point around New York and the fact that actually often, while it's always the number one place to go for companies, the holding period, so what we're looking at here is the average portfolio turnover of the institutions within each of the locations. And what's interesting is as you go from west to the east coast, the institutions become shorter term on average, so their holding periods become shorter. Clearly there's even quite a big jump there between Boston and New York, so that really is where obviously there's a lot of opportunity for companies to be meeting with investors that aren't really don't really fit the profile of what they see as an ideal investor target. Okay, so I wanted to think for a second around what type of institutions would maybe not show up on broker recommendations, on broker lists, because of a number of factors, maybe related to the fact that within a large market their asset base is slightly smaller. Either they maybe are actually very long term and don't trade very much, therefore their commission flow is slightly lower. These are the type of institutions that we see as good quality in terms of tier 2 investors, but they often don't appear on many of the broker lists that we see. The top example you see there, so these ones, the lost in the crowd example, a lot of these institutions based in the New York metro area, yet they very rarely show up on broker lists. They're outside of those core group of household names that people think of when they think of New York. Tweedy Brown, for example, has a sizable portion of its assets invested in Europe. I think it's as much as 50%. And quite simply, they're very much a deep value fund, looking for funds with low leverage, trading below their intrinsic value. They also have a couple of funds, a couple of strategies around companies that are engaging in share repurchases. So on this one, we're looking at some of the institutions that maybe are second tier purely by their location. So, we talked about Denver, but we're looking at Dallas and Philadelphia here as well, which are locations which aren't generally frequented by a lot of European investor relations teams. However, some of these institutions, if they fit with your investment case, can be incredibly good targets. So an example here is Barrett Hanley, which we always actually receive anecdotally very good feedback on from our clients. Very, very long-term oriented investor, very focused on income, like essentially companies that are demonstrating growth in their dividend payout over time. And 13% in portfolio turnover really points to an extremely low long-term outlook. And then the last one was, I guess, really a combination of some of the tier 2 location and turnover. But these are some of the names that we've heard anecdotally have been really great meetings for European companies. So we generally don't see them pop up. And Montag and Caldwell we're actually seeing a lot more of now. They are really looking for, they are growth and they're looking at above sector growth earnings, but they're also looking for companies that are generally trading slightly below their sector valuation. So some of these names are, through our research, have turned out have had really great engagements with companies and management team, but generally don't appear on many of the broker lists that we see. So when thinking about building the targeting plan, and I think this is a common complaint that we hear from many companies that we speak to. We always seem to meet the same people, and when we look in detail at the targeting approach that's taken, we look at the process that they're going through. Often we find that it's really around the most basic form of targeting, i.e. who owns my peer companies that maybe doesn't have an investment in myself or is underweight in our company today. And what's interesting is actually how that's likely, just by going through that process, is always likely to lead you back to the same set of people. So in this example, we showed a quick case study of a consumer brand company who was going through this process, and they're comparing themselves to their closest competitor. What becomes quickly evident here, just by looking at their top 10 investors, is just how much commonality there is between the funds at the top of the list. So there's 5 out of the top 10 between the two companies are shared. This company then looked at it and said, okay, we want some new ideas. We need a different approach to try and potentially unlock some additional potential and bring some new names to the top. So when they looked at their investment story, there was really a few things that stuck out. So from a financial standpoint, the consistent growth in sales and earnings, which is something they were highlighting strongly in their investor presentations, strong operating margins, and a consistent growth in the amount of money that are returning to shareholders through dividends. So their next task was to say, well, who else in the market shares those characteristics, regardless of whether they have the same set of customers in their business than us, so regardless of their industry. So these were the screens that they applied. So they wanted to capture, obviously, the index that they were in, so the S&P, market cap of 30 billion or greater, to make sure they were capturing the large cap market. Companies that were demonstrating EPS growth over a long period of time, over 5 years. Filtering further by the margin profile, we mentioned that margin was a key aspect of their investment story. And then finally, and this was really a big cut in terms of putting them into a small, unique group of companies, was saying which other companies have demonstrated the same sort of dividend growth that we have over a long period of time. Now, coming down from a universe of 500 companies, they now had 7 other companies that actually shared those unique set of financial characteristics that they were highlighting to the market. The company can then do, of course, is look in detail at who is investing in this group of 7 companies, who have been the recent buyers in this group. And the buyers part of it is important because clearly companies evolve and financial characteristics change, but a snapshot in time, if you can say who looks like our company today, you can really focus in on institutions that like or attracted to those characteristics. Now, this is not to say that this is necessarily a replacement in any way, shape, or form from looking at who owns my industry peers, who's been buying in those. That's absolutely an important part of the process. It clearly gives you visibility into who understands the dynamics of the sector, who has a track record of buying companies with this group of customers. So there is a lot of value in that process. But this type of approach can also be very complementary for companies, and I think it really has 2 benefits. One is to really to validate the existing targets that you may have. So they may be holders in your peer group that you've been targeting for years. So you're able to validate and prioritize within that group. And the second part, of course, is actually throwing out some names that wouldn't have come up just using the sector-based approach. Okay, so next I just want to talk about how some companies then go about putting their targets. They've identified the institutions they want to look at. How then to go about structuring that into a plan that is actionable, is realistic, and importantly can then be measured at the end of the year or at the end of the time period that you're considering. So in this case, the company, I just wanted to show you an example of how a company structured its outreach. around its core shareholders that it wanted to maintain alongside the new targets that it wanted to develop. So this system essentially breaks down both groups into a simple tiering mechanism based on the quality of, or the type of access that they want to provide those institutions. So within Tier 1 contains a combination of the most important shareholders, so your top active shareholders, which clearly need to be managed regularly, alongside the highest qualified target funds. For both of those groups, the recommended access there is clearly one-on-one meeting with management, with the CEO, CFO. Within tiers 2 and 3, the quality of access, if you like, goes down. So they may be more appropriate for an IR-only meeting or for a large group setting with management, for example. Clearly, within this plan, you see 234 investors. I think for a lot of companies, they're interacting with many, many more funds than that over the course of the year. We never see any examples where someone will be hitting all of the institutions that they put in their plan. That's just not realistic and is very rare. But I think having a structure like this has helped many, many companies, particularly when it comes to as we saw earlier, the growing demands from the buy side on company management time. But then importantly, when you come back to then measure the success later on, it makes it much easier to do that. Let me show you some examples of that now. Okay, so based on that same structure around the tiers 1, 2, and 3, clearly if you come back 6 months or 12 months later, many companies are saying, well, okay, how do we do in terms of overall activity levels? How many people did we get out and cover versus who we said we would? So running these kind of statistics around overall activity levels, we saw 20 of the 25 tier 1s, 27 of 50 at the tier 2 level, etc. can give you a sense of how well you covered that market. Of course, looking geographically, it can help future travel plans. How well did we see the people that we said we would in each of the individual geographies? There may actually be reasons why, very good, valid reasons why the reach score may be zero in some of these. Maybe it's the investors weren't available, maybe they're not appropriate targets. But there's a lot of insight that you can draw just by running some simple analysis around coverage as a starting point. So coverage is one point, but the other thing that I think more and more companies are wanting to do is trying to measure quality when it comes to our activity. And I wanted to show you an example of that in looking at conferences. So in this example, the proxy for quality is really two things. So it's investment horizon, i.e. saying we want targets that are long-term. So investment horizon is short to long across here. And purchase potential. So we want to target funds that have high purchase potential, have the capacity to be among our top shareholders. So each bubble here represents the average investor met based on both of those metrics. The size of the bubble represents the number of investors. So when you look at the size of the bubble, it tells you about, okay, how much exposure did we have? If you look at the Morgan Stanley Industry Conference up there, that is the largest bubble. So that we saw the greatest coverage of investors at that conference. The quality side, however, is showing you is the location of the bubble on the chart. So this company here clearly does a lot of conferences. I think when they come at the end of the year, as many companies do, and say, okay, we probably do too many of these. How do we understand which ones we should continue with and which ones should we maybe consider dropping for next year? And this sort of analysis of quality can help you do that. So clearly the conferences within the bottom left of the chart will be the ones that you'd want to look at in more detail. And this kind of analysis is never going to absolutely never going to replace the qualitative assessment of how management and how investor relations felt about these events. Absolutely not. That will always be there. This is really about bringing in some some data as well. And I think a lot of companies say that we're short on data when it comes to measuring effectiveness around IR and targeting activities. I wanted to share an example with you of that.
Can I just ask a question?
Yeah.
How would you go about getting the data which this is based on?
Sure. So this particular example, so NASDAQ have the calculation for purchase potential, but that is something that exists in many places. You could swap that out. For example, you could just run, you could do assets, or you could do something simpler. Investment horizon is just calculated based off portfolio turnover, which is quite readily available across the market. It's fairly industry standard data. I can help you out with that after the.
So
if that helps.
For example, if we take a Morgan Stanley industry conference,
Yeah.
you go about all the fund managers you saw during that conference and rate them on investment horizon and purchase potential, and then.
Exactly. Yeah.
Okay.
Yeah.
So say if you're there for 2 days and you see 20 asset managers,
Mm-hmm.
you rate each asset manager and then derive that bubble.
That's what's happened in this case. Yeah.
So it's not the sum of all the asset managers that attended?
No. So it's no. So that's an important point. So it's the meetings that the company did. So it's really a function of two things. So then it's a function of the attendees at the conference and how high quality they were or how appropriate they were for the company. But then it's also really taking into account the corporate access piece around which meetings did we get at the conference out of the sample of institutions that were there. We have seen this run, so we've run something similar for the oil and gas sector, looking at aggregating this across a number of companies and seeing which are the best conferences or the highest rated conferences on these type of metrics.
Sorry, and do you calculate this based on a 1-day average? Because you could attend 2 days, of course the bubble will be bigger.
Sure. Yeah. So actually no. There's no point in terms of the number of days. So what that will influence is the size of the bubble. Yeah, absolutely.
This is then misleading, maybe if you attend 3 days.
Sure.
instead of 1.
Yeah, absolutely. I see that point. I think whichever way this is the way that a company ran this way. I think the thing they were more focusing on was really the location of the bubble. So where on the spectrum, on the quadrant that it was falling. Sorry, I think.
I just really want to follow up on the purchase potential.
Yeah.
So is it basically a black box, or is the methodology available that you use?
Oh, sure. Yeah, absolutely.
For calculating this?
I can share it, and purchase potential is a whole topic in itself because it's clearly very difficult to apply one methodology across the whole market. However, there's the way that it's been done here is really around a market cap weighting. So looking at how each fund distributes its portfolio by market cap. So every fund will have its own curve, essentially, how it distributes its funds. And then equating the largest holding within this company's market cap band. So saying, okay, within companies of a similar size, what are the largest positions that it takes in other companies, right? And equating that essentially back to your shares. So it's quite again, there's no perfect way of doing this across the market, particularly across geographies when you're dealing with, say, US institutions in a German company and the mandates, for example, the proportion of assets allocated to Europe may be much smaller. But it's quite a clean way of doing it, given that it's based on market cap, and it, again, but you can get very, very detailed with that calculation for sure. Yeah, other questions on that? No.
Is it at the firm or fund level?
So this one was at the institution level, but we have done it at the fund level. I think where it becomes tricky is when you're meeting a person, not a fund, right? So and then that person is then connected often to a number of funds. So what you can do is then say, all right, we met the institution. There were 3 individuals in the room. let's take every fund that they have some influence over and take an average of that. So there's a few ways you can go about it. But I think when it comes to that, the detail, and really what you want is, this is a flat sort of two-dimensional presentation, but to drill into the bubbles and say, okay, what was the underlying meetings there? This kind of thing really serves as a great starting point for that conversation around the end of the year, saying, what did we do last year? What did we think was effective? And how would we adapt strategy for next year? Which events would we maybe drop? And we've seen, companies apply this type of thing quite easy to roadshows as well. I mean, these are events here. By definition, they're very flexible in terms of how you can apply them. And as you said, you can factor in the number of days. You can slice it a number of different ways to try and get a better sense for how effective activities have been. Okay, so just some of the takeaways here. Again, the growth of the ETF, the passive management market, I think is definitely putting pressure on the active buy side, as we've seen. We think that's still very good news for IR teams in terms of really appealing to stock pickers, really looking to define that financial equity story, try and define additional competitors for capital that are outside of your core industry peer group. Again, just planning, we really think that it's worthwhile looking further downstream in terms of asset managers, what is being missed fundamentally by the corporate access model today. Maybe there are some institutions that actually are very compatible with your company, but maybe they don't have the commission flow that others do. Maybe they're a location that you're not used to visiting. But all of these names are worth looking at and assessing whether there is some compatibility with your equity story there. In terms of the framework, I think we see more and more companies, taking this approach of laying out very clearly the investors they want to see within each bucket and how they're actually going to address that group of funds. So maybe some will be just within the conference schedule, others are prioritized for one-on-one management access. Even as we know, if things end up being different, having that plan makes it easy to then come back and measure effectiveness at the end of the year. Okay, that's it for my slides. Do we have any more questions?
How do you get the data from those roadshows into the system? Is the IRO entering it, or is it interaction with an account manager? How are you capturing that information?
Sure. So, there's a variety actually that we don't really discriminate in the sense that if a company asks us to do that type of work for them, then they'll just give us the information that needs to be done. But a lot of the times the companies are doing this kind of analysis themselves. I mean, this is something we've seen many companies start to do. Just say we need, a lot of these, talk to some of the sort of biotech and pharma companies, and they say, we're scientists. Like, it's not enough for us to go out and measure what we're doing just based on how it feels. Like, we need more data to support that and back it up. We've helped companies with that process, and but yeah, I mean, it can be either. So there are systems, obviously, many contact management systems available, not just for IR, but general purpose as well. Any way that meetings are being logged in a sensible and consistent way, you can run this type of analysis. Sure.
Concerning the peer analysis,
Yeah.
is that also a service you would provide, or how do you
So I promised I wouldn't talk about our services. So yes, we do. But what I would say is that a lot of that work can really be done by just thinking about with some quite generic in a way market data, right? The screens that we looked at earlier are quite simple, right? Just around margins and earnings growth. So I think there's also a lot a company can do in terms of thinking about, okay, how does the story, the presentation that we take round to the investment community, how does that translate into how we could actually screen for competitors for capital? And sometimes, and it's not just, it doesn't just work for the largest companies that have, very clear positive aspects to their investment case. This can also work in another way as well, which is to say, if there are regular obstacles to investment that you feel, in meetings all the time, whether it's, liquidity is an issue, whether it's leverage is an issue, all of those things can be factored into that type of analysis. So you say, okay, here's our core investment story. We're growing margins expected to over the next few years, top line growth as well. But we want to make sure that the institutions that we target are comfortable with investing in companies with our leverage, similar leverage to us. Those type of things can form the screen. So to answer your question simply, yes, yes is something that we do and that others do. But I think there's also a lot that companies can do today by just thinking about what are the types of things they'd want to test for in this type of analysis. Because I think time spent on that topic at the outset can be really beneficial in terms of.
My question was a little more granular. So if you want to know which investors invest in which companies, that's.
Oh, I see. Yeah, so just on the ownership side. Yeah, so well, obviously, ownership as it pertains to public filings is available in a host of investor relations platforms, including the NASDAQ version. So, within that type of system, you could define who these competitors for capital are, create, essentially a custom peer list within that, and look at the ownership flows into that group and the largest owners. Hi.
Yeah. I think you presented pretty much what we would call outside the box approach to target the incremental buyer and to see new faces on the roadshows.
Yep.
However, I wonder if you have any experience or feedback that you can share with us once these targets are contacted and invited to meetings. First of all, take the meeting because I can invite them as long as I want if they are not interested in the industry or in the company, even though they share financial similarities. And second of all, when I imagine having a meeting with somebody who's not familiar with the industry, it might be talking to generalists who are very general expert.
And you wouldn't want management in those meetings,
so
right?
This
Yeah.
Is something. Does this work out? Do you have
Sure.
any grip on that? If there's success in this, or is this just some fancy things you can do once in a while when you're in the mood?
Sure. So there's a few bits to that. So there's no doubt that there's not a silver bullet when it comes to this, right? There's no one answer. So this idea of you contact an institution that maybe isn't a major holder in your sector, and you say we'd like to meet you, and they say sorry, we're not interested. I think that's in reality that's always going to happen. Particularly if you are going out and looking beyond the obvious. By definition, you're trying new institutions. But if you also have a view on why they should be interested, I think you'll make fewer of those mistakes. And that's the experience that we have in terms of companies saying, okay, we can at least be focused with our requests going to new investors, so people that we haven't interacted with in the past. Yes, I think it has been successful, and I think it's been feedback we get from some companies it's been quite validating. There's always that confidence of speaking to a new fund that you haven't interacted with before and saying, we understand the type of institutions that you've been investing in recently, just knowing that share our growth profile, within our market cap range. Knowing those things can be incredibly, I think, powerful and give confidence to an IR team looking to meet new investors. Should you take management to someone that, that's another question. Probably not, right? If you're going to meet a generalist.
Depends on management, yeah.
Sure, absolutely, yeah. But to your point, yeah. But I think it's about, okay, You know, you separate the group from, okay, who are the key targets? They're huge holders in our close competitor. We have to be talking to them, constantly trying to convert some of that capital over to us. We want management involved in that. We want them to be, you know, talking about the dynamics of the sector, a sector that they already know very well. Separately, you know, as an IR team, we want to be, you know, nurturing and looking outside for new funds that maybe aren't showing up through traditional channels, that, you know, maybe over the longer term. You know, by definition, some of the funds that we've looked at today have a very long investment holding period. So the flip side of that, of course, so that sounds great. You know, the stereotype is long-term, high-impact funds, but actually, often that takes many, many meetings and a long research process before they take a position. So I think there's two tracks to it, and you have to just decide on a case-by-case basis.
So when do you give up on an investment? You know, sometimes.
Great question. That's a great question. Yeah.
You know, Fidelity, Capital, everybody wants them on their shareholder register, clearly. But you know, sometimes you hear companies say, well, you know, we feel we just give them an update on the industry and they use us in a way. So when do you draw the line? Is it after a year, 5 years? When does that point come?
So that's a very difficult question because, well, there's no answer to it in one way because, you know, I think all you can hope to do, as we know, investment preferences, other than at the very extremes of the spectrum, you know, can change quite a lot, and certainly have done for many institutions over the last few years. So this idea of you giving up on someone, you know, sort of blacklisting an investor, I think there'd be only a certain circumstances where that would be appropriate. So I think, you know, what a company can do is understand, you know, why that is, and often it can be, you know, contextual information about what else is that investor doing, why aren't they interested, what are their other movements across the market, what types of stocks are they buying elsewhere, is there a fundamental misalignment between those companies and what we look like today. And sometimes they'll tell you as well, like, just, you know, quite clearly why. So I think it's difficult, but, you know, as we saw earlier, you know, there really are a finite group of institutions. It's often not about completely new names. It's not like there are hundreds of new asset managers popping up every year with billions under management. It's just not the case at all. You know, so it's really about prioritization. It's about who's appropriate now, and just really, you know, using that sort of prioritization structure that we saw earlier to say, well, we want to keep engaged with this investor, but, you know, large group meetings are fine, seeing them at conferences, they're not a priority in terms of our scarce resource that we're managing, which is our management time. I'm sorry to not give you a straight answer with that one.
There is no straight answer, I don't think.
Sure. Hi.
Could I perhaps come at that from another angle then? If
Sure.
you say, okay, I've got such and so much time now, we think Fidelity or whatever I'm going to give us, maybe not a fair shake, but we're one of hundreds. Is it then worth concentrating perhaps, like you said, or looking at the tier 2, so you go to Denver, Houston, Dallas, whatever, and they might even then be, the investor would be more grateful for the time you allot to them, you're then one of 10 rather than one of 100.
Sure. Well, so to the second part of your question, that's actually, we have heard that, is that companies feel like if you go to some of these second tier locations, you actually get a better audience internally at some of the buy side firms. You get a better representation across funds. You actually get quite a representative audience. Of course, the flip side to that is that, you know, if it doesn't work with one or two institutions, a lot of these locations are characterized by one large institution and then not much else. You know, that is, you have to be really careful about, okay, does that investor actually fit our profile? Does that make sense? And I think with the tier 2 locations particularly, that's where the most homework needs to be done, if you like. So I'm not going to say to anyone, like, you know, don't go to New York. I just think it's a different question, right? It's about how do you prioritize when you're there? How do you ensure that actually you're meeting quality in New York or Boston rather than just, you know, the list of recommendations that you get, a list of people available. So it's a balance, but, you know, when it comes to the tier 2 locations, That's where the research and really understanding what the institution is attracted by and what the types of companies they're investing in is really important.
From your experience, how do the companies you help actually go about seeing these tier 2 institutions? Because obviously, from my experience, brokers aren't really helpful in that aspect. Do they then approach them directly, or do they ask the broker to approach those? What is your experience?
Sure. So what?
Do you assist the companies with their approach?
So I can answer the last question first. No. So I've actually seen a variety of approaches be successful, and I think it really does depend to some extent on maybe the size of the company you are and the profile of the company that you are. We've seen examples where the company has directly contacted institutions in tier 2 North American locations and been actually surprised at how receptive they were to that direct approach from the company. Conversely, we've also seen some people say to the brokers, well, no, these are the people we want to see, and we want you to make that happen. And of course, there's always a trade-off and a balancing act between the institutions that they want you to see, and you have to sort of give and take on that a bit. So, but I've seen sort of both approaches be successful. I think more broadly, the buy side, I think, has to become more receptive to direct outreach from companies. And we've seen a few examples of that. I want to say that's a mainstream trend, but I think those dynamics are, will change a bit in the future.
Is it an issue that there isn't this consensus building role? That's the role of the broker, right? He's saying the same thing to 200 institutions, and you hope to make an impact. And here you've got one company phoning 20 institutions and trying to make an impact, and it feels difficult. It feels like there's a huge bridge.
Sure.
And this is possibly an institution that has no access to a broker, research.
Sure. No, absolutely. I think that's an interesting point. But I think if we think back to the distribution of assets, I think the institutions you're talking about really occupy that. Maybe to tier 2, but into tier 3. I think there's still a group there that even by most European standards would be sizable institutions, but just structurally are underserved by the market. So I think they're well enough. I mean, you're right. It's a point, and this is this idea around from a resource standpoint. You have to be clear on, if you're picking 20, that's possibly doable, but maybe even less. I mean, maybe it's all about being very, very specific in terms of who you're talking to. But you're right, which is why there has to be a balance between creating the noise and benefiting from the efficiency that brings, but also trying to nurture other long-term targets from an IR standpoint. Does that help? Anything else? No? Great. Well, thank you everyone for your time.